Aloha, aloha, aloha. Thank you, ladies and gentlemen, for taking the time to watch this video. My name is Brent from iHaveSuccess.com. This is your daily cash flow video game. If you haven't played this before, the way that you win this game is at the beginning of the game, you choose a dream. I'm choosing the dream of Gift of Faith. When you're out here on the fast track, you either land on your dream or you land on these green opportunities and you accumulate $50,000 of passive income out here on the fast track. Those are the two ways that you can win the game. In order to get on the fast track, you got to get out of the rat race here. To get out of the rat race, you land on these green opportunities and you accumulate more passive income than you have monthly expenses. So we'll choose this. We'll get the game going. And while we're doing that, today we're going to be listening to everyone's favorite financial accounting information.
In this series of videos, we're going to talk about preparing and understanding the financial statements. We're going to learn your income statement, the statement of earnings, now. But before we learn how to definition. If you already understand the definition listed there, you can skip ahead. This video is. But if you're shaky on any of them or you're not too sure, we're going to run through the definition of each one. You can't do without understanding. The first one is assets. I'm going to look up the Wikipedia definition. Wikipedia is people crap on it from time to time, but it's not a bad thing. Wikipedia definition of assets. Financial accounting, assets are economic resources, and what is legal. All controlled account that is held as part of the now, simply stated as the ownership of value converted into cash. Cash is also I think the definition you'll find I think what you'll find if you look up in your textbook is they'll often talk about future economic benefit being distinguished from an asset. I would say that at the introductory level, these are both too complex. So in the textbook, it might be a little too complex, a little too complex. I would say at the very beginning of the book, you need to think about company owns and control that has a benefit to the company. So I'm sitting here in my office. I don't need that. It's my uniform. The desk is an asset. These are all assets of the company. They owns it, it's It's important to know them. And they can't buy their stuff. So assets keep the company's own control.
Happy New Year, thank you. How you doing?
Examples of assets.
So far it's been kind of slow.
The most common, probably the most important example of an asset is cash. And the reason I say it's the most important is when a company runs out of cash, they're dead. Another type of common type of asset you're going to see is accounts receivable. The shorthand for that is AR. Accounts receivable are whenever a customer comes in, they buy something from you, and they don't pay the bill right away, they promise they're going to pay later. It's a short-term asset to you. They owe you money. That's an account receivable. The next type of asset on your list is inventory. You think of Walmart, Home Depot, and they have stuff sitting on their shelves. Well, that stuff is assets. That stuff they own and control. They're planning to sell it to you. That's called inventory, and that's an asset to that type of thing. The final types of assets on your list are property, like land, buildings, and last, equipment. Any piece of equipment like the computer you mentioned earlier, or the desk, these are assets. The building I'm in is an asset, and the land it's sitting on is also an asset. These are all examples of assets. They're all stuff companies own. available to your company. Next, we're going to talk about liability. Liability, Wikipedia, as an obligation arising from past transactions or events. And I think that's a great definition. Again, to put it in simpler terms, I would say is anything that the company owns. The key word is own. Assets are owned, liabilities are owned. If the company owns something, that's a liability. Common examples of liability are things like bank loans. If your company is from the bank, that's a liability. And often, liabilities feature payable. You see it all. Bank loans, payable, mortgage, payable. If it's got the word payable, you can be accused of liability. I quickly glossed over accounts receivable. Again, that word receivable, if it's got the word receivable, you can be sure it's an asset. Back to liability, ownership of the company owns. One final type of liability that I haven't mentioned is accounts receivable. And these are the short-term liabilities, like I received a phone bill, paid debt, account payable, phone company some money. Bank loans, mortgages are more long-term in nature. It might go over a number. Accounts payable, you have 30 days to pay, so that's okay. There are other liabilities, but I just wanted to stick in your mind that the word payable is often key here. But think of it as anything that a company can own. Alright, on to our third topic. So again, we have assets, the company, and liabilities the company owns. Our next topic is shareholders. Let's read the definition off of Wikipedia. They say equity, we're going to call it. It says, finance equity is a residual claim or interest in major junior class investors on assets after the liability. The word amount always uses the word text. In this case, Wikipedia defines it. I think the easiest way to think of equity is actually an holding, and I'll explain. So, I recently bought an account notes, and the account notes cost me $300,000. Beautiful account notes. That's an asset. I own it, I control it, I can sell it if I want to. An asset, that's what it is. I'm going to call it construction. I don't make a lot of money. I don't have $300,000 in cash in that. So as you can guess, I got a mortgage. When I got a mortgage, I went to the bank and said, I don't have $300,000, I don't even have $200,000, I don't have $100,000, I got $50,000. I need to loan $250,000 to buy this. I got a $250,000 mortgage. Again, my townhouse is $300,000. My mortgage payoff, my mortgage payable is $250,000. So, how much of my house do I really own? Well, the amount left over. The equity in the house is $50,000. That's my piece of the house. In much the same way we can think of shareholders. You've got $1 million worth of assets, $800,000 worth of liabilities. The shareholders must only control that last $200,000. Now, the company's they use the asset and paid off the liability. What would be left for the shareholders? The shareholders' piece of the pie. That's how I want you to think about it. So, assets, the stuff the company owns and controls, that's good for the company. The stuff the company owns. The piece left over for the shareholders, all their liabilities, using all their assets. What's left for the company? What's the shareholders' piece of the pie? That's their equity. That's their shareholders. Okay, last one. Yeah, 2 more to go. Oh, before I get to that, a couple of key accounts in equity would be retained earnings, and that is whenever a company makes money, the shareholders get a piece of the pie. The account we use is called retained earnings. The other key shareholders' equity is common shares, and also preferred shares, and classes. Beginning though, we're just going to look at normal common shares. We also want to classify it under equity. When the company decides they want to take money out of their company, they put it in the form of a dividend. And we'll look at all of these terms. They're all going to play into our financial statements. But for now, I would just memorize it. I would say, okay, retained earnings, common shares, perhaps, and dividends. And also, equity plus stuff anything coming and almost always be money right after when the company owes something. And last, equity. That's the owner's piece of the pie, what's left over. Okay, last two definitions, and we'll get ready to jump into some real deal financials. The second to last definition I want to look at is revenue. You probably have a good idea what revenues are. I mentioned that Wikipedia is a good source. This one got vandalized with revenue, and then it says in Andy Carlos. So the guy named Andy Carlos vandalized in accounting. Revenue is income that a company receives from its normal business activities, usually from the sale of goods or services to customers. I want to know that word earned. So if I go to Walmart, their revenue will be sales revenue because they sell it. If I go to a repair shop, they'll have repair revenue because they repair your vehicle. If you're a university or a college, you're paying tuition. The university is paying tuition. Revenue is whatever the company does to earn their money. The final concept I want to define is expenses. And again, it's a sorry expense for expenditure of household money and other personal an account of expenses very specific. Cash or other value assets another person's income. Look at the key point is it's a technically an expense in which an asset is up for a liability. And this is really the final definition. An expense, in simple terms, is a cost associated with the business. So let's say I want to run a hair salon. What are the costs of running a hair salon? Well, to keep the lights on. So expense. I have to pay hairdressers. I have to pay them salaries or wages. Salary expense. What are the costs of that type of business? Maybe I have a rent expense. I could have a property tax. There's lots and lots of expenses. These are the costs of doing business. So when I think of revenue, I think money coming in. It's not always going to be tied to cash. We'll talk about later. Expenses are costs of doing business. A few common ones are utilities, salary, rent. There are hundreds of expenses. So, getting back to that very I think at the end of the video, you have a good understanding of what is this. It's the stuff that owns and controls that's food for the company. Again, benefit, I think, protecting liabilities of anything the company owes. Almost always it's going to be half. If I get a phone bill, I don't pay him back in a month. I pay him back in money. But sometimes you can also shareholders' equity. We talked about that's what's left over for the shareholders. That's the shareholders' piece of the pie. And revenues and expenses. Revenues are